Are in listen-only mode.
Good afternoon, everyone. I, Sneha, on behalf of NEN and Vadhwani Foundation, would like to invite you all for this webinar and also introduce our expert. Mr. Anil Joshi is the president at Mumbai Angels and heads operations both at Mumbai Angels and Bangalore Angels. His professional experience includes involvement in corporate management functions in medium and large organizations, investment in startups, project management, joint ventures, and business development, and sits on board of 4 portfolio companies. He has worked with Birla Group of companies, Business Access India, Transasia Biomedica, and Artheon Group. While at Mumbai Angels, Anil was instrumental in closing over 15 deals in Mumbai Angels. He has bachelor's degree of engineering, PG in management marketing, and PGDBM in strategic finance and control. Before I hand over the floor to Anil, here are a few pointers for the audience. You will all be on mute. You may ask questions by typing in the panel provided. Over to you, Anil.
Hey, hi, thanks. Good afternoon to everyone. Before I begin raising capital, debt or equity, we'll quickly run you through Mumbai Angels for a minute. Mumbai Angel is a no-profit organization based out of Mumbai, and it's an angel investment platform for early-stage companies. We invest anywhere around $100,000 to $500,000, which is 15 lakhs to 2.5 crore. And till date, we have invested over 60 companies across sectors. With this, it's my pleasure to run a session on raising capital, debt or equity. So I'll just begin with my first slide. So before, since I'm not aware about the type of audience, would run through some of the pointers, type of companies, and why it is important. Because some of you on this webinar may be interested in knowing some basics about type of companies. So whenever a company starts, most of the time when an individual starts at a very initial stage, could start as a proprietary company, which is basically a single owner. And the typical example of proprietary company could be architect firm or consultancy firm. The next graduation from proprietary is to partnership, when two or more partners come together, bringing complementary skills on table. When they join hands, then it becomes a partnership firm and is governed by partnership guidelines. The third format is limited liability partnership, which is basically enjoying the benefit of partnership at the same time enjoying the benefit of private limited company. This is a very new form of company which was introduced a couple of years back, and mainly to encourage partnership companies to move to LLP to avoid unlimited liability on partners. The next is private limited company, wherein you register your company with register of company, and you have shareholders, and you draw down memorandum and article, and you issue shares, which could be in form of equity for initial shareholders, and then preference share and other form of shares. The next is public limited, when company go on stock exchange, when they raise public money through exchange, then it becomes a public. Company could even be a deemed public limited when they have shareholders above 50 in a company. It's very important to understand the type of company, because that will define whether you would like to raise capital, whether it's debt or equity. Relatively, it is tough to raise equity in proprietary and partnership, and in some sense even LLP. However, I think banks are quite open to extend debt which is basically a loan to proprietary concern or partnership or LLP. If you need to raise equity capital, then I strongly suggest one to look at private limited or public limited when you go you raise an IPO. So the very basic question, for any entrepreneur, should I raise money? Because the freedom of having 100% ownership or being a debt free is far higher than raising any debt capital or equity capital. So even if one raises debt capital, they are bound by certain compliances. Banks would ask for regular report, maybe monthly, quarterly, or 6 monthly, depending upon the type of loan. Or even if equity, you would be required to go through of MIS. So the answer is only if you have to. Why one raise capital? Quite obvious. Either they are not able to manage, there is shortfall in working capital, or somebody needs capital for expansion. And if your internal accrual or your self-worth doesn't allow you to fund your growth or working capital, that's the time you go for raising debt or equity capital. Moving to next slide, which talks about type of capital. One is debt. Basically, it's a loan, and it can be raised from various sources. I am highlighting only two, basically from institutes. One is non-banking finance company, companies like Tata Capital or India Bulls or Reliance Capital, or there are a host of other non-banking finance company which provide debt capital. And the next is banks, could be nationalized bank or private bank, where individual can go and raise debt, which could be short term and long term. Short term is basically taken for meeting your working capital requirement, and long term is basically to meet your capital expenses. There are other format also, but as far as company is concerned, I think these are the only two entities from where a company can raise debt capital is NBFC, second is bank, and of course the shareholders in company or directors on company can also extend a loan, which is basically a debt finance. Equity, I presume there could be a lot of early stage companies in audience. So equity capital could be raised either your own capital, which makes you the owner. The second source for raising equity capital is family and friends, where you raise capital and you issue equity against that. Second is angel investors like us, where you can raise anywhere around 50 lakhs to 2.5 crore. Today in India there are several angel group. To name few, of course, Mumbai Angel, then there is Indian Angel, then there is Bangalore Angel, Chennai Angel, Hyderabad Angels, Kolkata Angels, and Howard Business Angel. There could be more, but these are prominent group and very active in this space. Post angel investment, when you need more capital for growth, that is upward of 2.5 crore, or you can say 5 crore to anywhere around 2 crore, anywhere around 20 to 25 crore, then you go for VC, which is venture capitalist. There are venture capitalists present across country. The details of venture capitalists could be available on website, but to name few, Sequoia is one, Nexus is one, then Safe Partner, Canon Partner, K Capital, Bloom Venture, Nirvana, Inventors. So I think there are a host of venture capital firms which provide early stage funding to growth stage companies. Post growth stage, when you raise upward of 100 crore, 50 crore or more, then you go for private equity. Basically it's the same format, but VC normally invest a smaller amount at a growth stage company. P invest larger amount, basically companies which have pre-IPO stage, and IPO is initial public offering. For example, you must have recently heard about Textile, which was funded by VCs, and Textile has just raised initial public offering on stock exchange. Going to funding band, I am talking from initial stage till time you go for IPO. So when company is at a discovery or idea stage, when you have just found company, normally you would raise money from either, of course, founders bring initial capital to form a company, to fund their idea, or to have proof of concept. Post that, the very natural choice for any founder is friends and family. Once proof of concept is done, then company is basically pre-seed funding stage, where they can raise money from individual angels, where somebody will invest money in company for exchange of equity in individual capacity, or else you can look at angel groups, which I named while taking up previous slide. Post that, once product design has been done, company would need money for product development or market development. That's the time you raise startup funding, and this could be basically an overlap between angel group and seed funds. Then you go to venture fund, institutional equity, and then of course banks would be also happy to look at company once you have built a network for company. So this is basically a funding band. Would be happy to take questions during Q&A session. Finding the right investor is hard. It's not difficult, maybe hard, but this slide basically just gives a snapshot. There is no revenue, or raising a fund could be very expensive. My partners don't like it, or team is weak, not even enough traction. These are the kind of question you will come across whether you are raising debt funding or equity funding. This probably will help you to prepare better. Normally a company which is addressing very large market becomes very attractive for investors. One which have a strong team also becomes very attractive. So this slide is basically to give you a snapshot what kind of questions you should be prepared for. So I'll move to next slide. This slide basically talks about a difference between angels and VCs. I specifically kept this slide with a perspective where you can differentiate between which group you should target at a stage of your company. Should I be approaching angels, or should I be approaching VCs? There is a very small overlap between angels and VC, but when company is ready for VC funding and approaching angels, doesn't help. Vice versa, when company is ready for angels and you exploring with venture capitalists, doesn't help. So I will quickly run through all these points. Angels normally look at anywhere around 25 lakhs to up to 5 crore, whereas VC looks anywhere around 2.5 crore upward of 20-25 crore. Angels investors are basically individual investors who are willing to take risk at early stage. VC is basically institutional money, where they raise money from investor and then they invest in turn in companies. Angels are normally regional or geographic in nature. That's why you heard about a lot of Mumbai Angel, Indian Angel, or Hyderabad Angel, Bangalore Angel, Chennai Angel. However, all this group in India had been investing across India, so that's one difference even I have come across. Otherwise, normally angel groups are very regional focused. Investment vehicle angels normally at very early stage prefer common stock. If the investment amount is larger, then they go for preferred stock, which is preference share. VC would always do preference share. Angels are normally, staying in company for anywhere 5 to 7 years, where VC have a horizon depending upon at what stage of fund they are in. It could be anywhere from 3 to 5, in some cases even 7 years. The target return, what here it's very indicative, but it all depends upon individual to individual. The typical return expected by investor is in range of 30 to 40%. So this slides basically speaks about the approach when you are approaching an investor. What you should basically do. Identify a relevant target. Having said that, is basically if you are in IT space, and if you explore somebody who is in clean tech space, is basically a wrong choice. So one should clearly identify a right investor group who would be willing to invest in your venture. It is always appreciated if you have some introduction made for a potential investor. It's not difficult to find out. Maybe you can look at your close associates who can make introduction to either angel group or even bank or even venture capital. It always helps. It reduces your fundraising cycle. I'm not saying that cold call will not help, but it becomes quite longer compared to if you have an introduction. So always look out for some introduction who can make for you to potential investor. Once you have got introduced, always make a point to send a very short intro or a 1 page or 2 page executive summary or a link to your site. I think during first introduction there is no point sending 20-pager information memorandum or 40 slides. When you are getting introduced to potential investors, be very brief, be very precise, be very specific. It always helps. If investors are interested, they will automatically ask for more information. Be clear on your ask, meaning which in case your company needs 5 crore of funding, be very clear that you need 5 crore and for what. Most of the time we come across proposal where people will say we can take anywhere around 2 to 5 crore. So it's very huge range. 2 crore and 5 crore, it's almost double the ask. So that doesn't cut ice with investor. You should be very clear what you're asking and where you would be using your money. Never communicate a valuation, because in case investor likes, so most of the time you may be having a very interesting venture. However, sometimes since it's very difficult to value a venture, and you would ask for some crazy valuation which may put off your potential investor. So maybe you can keep valuation topic for last. It's always suggested you communicate more about what you're doing, what space you are in, how excited you are about it, how big is the market, and if investors like it, they will certainly ask for valuation. So I think this should be taken up last. Be persistent, but once declined, back down. So in case you have approached investor and investor is taking time in responding, maybe you can check up at regular interval. And in case investor is declining, then you should stop following up, because probably they will not invest and you will be only wasting your time. Hence, it's very important to follow up with only right guys who would like to explore further with your venture. However, keep sending regular update to your potential investor or people who have declined, because sometimes they may start liking your space and may be interested in investing in your venture. Rather rinse, repeat, I'll skip, note, be really friendly to assistants. Maximizing your chance of fundraising. Be honest. Most of the time, you may have some gray areas which you may want to cover up initially. However, it is appreciated if you can be honest to your investor, which all will appreciate and would be happy to acknowledge gray areas and work around the deficiencies. It's very important to establish credibility. Talk about team accomplishment, who are your advisor, what kind of value add they are bringing on board. Have a right kind of lawyers. If you have some existing investor, do talk about them. Maybe good to make introductions so that potential investor can talk to existing investor about their experience with venture. If there are any demos, make a point to show to potential investor. Be very brief, be very precise. Don't do demos for longer hours. Be very specific. See if you can complete demos in 5-10 minutes, which should basically give a flavor of what you're doing. In case you have users who are already using and benefiting from your venture, whether they are using your product or services, please highlight. That always helps. How, if you are in a internet, what kind of page views you have, what kind of partnership you have. In case you have some revenues, this is basically for very early stage companies to highlight. Even if it's tiny, it helps because that's a proof of concept. People have started paying for your product and services. And the company which are at growth stage, you would have some balance sheets to talk about. Maybe even talk about past 3 years performance and how do you see your next 3 years post funding. And if profits, please highlight. So this is regarding meetings. This is basically to help you when you have been introduced to some investor and you both have agreed to meet a predefined date and time and place. Then please do your homework. Basically, from what are the preferred area, what kind of investments they have made, what kind of value add they bring on table. Do they have any specific liking for sector? This will really help you building your case. You can talk about, or highlight about your ventures. Confirm, previous day for meeting. Mostly investors, once they confirmed, very rarely they will cancel the meeting. But it makes sense, checking previous day about meeting. Don't be late for your meetings. Normally nobody would say anything, but people do have their other commitments, and that will cut short your meeting slot. So take maximum benefit of your time slot with investors. Be on time. Find out how much time you have for meeting. In case your meeting is scheduled for 20 minutes, then there's no point bringing material which would take 30-40 minutes. So check with investor how much time you have for meeting, and then accordingly you can structure your meeting with potential investor. Make very precise, very simple, very crisp presentation which you can run through, and you can also speak about your venture when you meet investor. It is advisable that you send it a day prior to your meeting, the presentation which you will be talking about. Be confident, smiles, show passion. It's very important. Any investor who's investing in a venture looks for how passionate team is about their venture. So have that passion when you are meeting investor know your business well, know your pitch inside out. When you are going for a meeting, ideally you are expected to address all queries. However, in some cases you may not know something which you can borrow. You can borrow more time to come back, but you are expected to know inside and out about your venture. It is also advisable, in case you think you would need help from your team member, take them along with you for meeting. Teach them something is basically talking about sharing some new stuff about your venture with investors, so that they learn something and they would be happy to appreciate that. Don't argue. So it's sometime you get so attached to your venture, and if investor asks you any question, you may get offended. So don't be offended. Somebody is asking you a question because they don't understand or they have a query around it. It's basically an opportunity for you to understand the concern and help addressing them. So don't argue with investor. No point if they are not interested putting money. No point arguing, because that may create some bad reference. If you don't know an answer, say I don't know and we'll get back. Be precise, be specific. If you ask for 2 days, ensure that you reply in 2 days time. Be clear on your ask, which I have already covered. If there is interest, then ask on next step. Most of the time you would be able to make out whether investor is interested or not. If is interested, please ask on next step, and they would be more than happy to give you timeline basis which you can start following up with them. For follow-up, game of patient and persistent. It basically irritates you if you make 10 calls in a day, or you keep sending email reminder. Do it with the gaps, and email reminders. Ask for time. Can you speak to them? And it really helps. Don't make repetitive calls. A few hours after meeting, send a follow-up email thanking them about their time. Make sure they know you heard their issues. In case they have asked for some questions, send in an email that you have understood questions, and then follow on open issues, confirm on next steps. If you don't hear on agreed day, then send email next day. If you still don't hear, then call them. These are very basics. I need not be talking much about it, but I thought I'll just keep it for audience. Don't be insulted if they say no, because it may so happen you talk to some 50 investors and the 51st guy may invest in. So don't feel offended, and trust me, all investors, even if they don't invest, would be more than happy to help you or connect you to some investor. So be shameless in asking for help, and keep reviewing your spreadsheet and following up. So this is basically about what I wanted to talk about in this session. I had half an hour, and I have completed what I had to share with audience today. So wish you all guys successful capital raising, and happy to take up question and answer now from audience.
All right. Thank you, Anil. We'll start with the Q&A now. Our first question is from Prashant. He asks, if there are 4 people who have started a company, all the 4 people are shareholders and co-founders, so this company will be partnership or private limited?
So the very basic structure of company will define whether it's a partnership. So if 4 partners do a partnership deed, then it will be a partnership company. However, if they go to a private limited route, get company registered with ROC, then it will be a private limited company. So for partnership, you are required to do partnership deed, and for private limited company, you have to get registered with register of company. That's the basic difference.
Our next question is from Shubhradeep. He asks, if I am a founder of an event management company, how do you suggest me to raise the money?
So depending upon what is your fundraise. If you need a very small amount of money and it is mainly to meet your working capital, I would strongly suggest you exploring with your bank for working capital requirement. You being in service sector, probably will not need much of a capital unless until you want to go all over places and have all India presence. Being in a services company, you keep on also getting revenues. So I would suggest explore with bank for debt funding.
Our next question is from Suchita. She asked, I'm looking for an investment up to 2 lakhs. Which is the best option to go for?
So it's a too small amount, 2 lakh. I don't know what venture or what idea Suchita had, but probably the 2 lakh of money could be raised from their own savings or family and friends, or else could be even from bank. And in case they are looking for some grant or subsidy, then there is a scheme under DSIR where they provide a grant up to 5-7 lakhs for innovative ideas. So that may help them. You can go and visit DSIR website or DSC website and explore for what are the mechanism for availing grant for interesting idea. But for 2 lakh kind of rupees, I think better to get it from family and friends.
Our next question is from Neha. She says she would like to understand why even after winning Best Business Plan by Goldman Sachs itself, she's finding it difficult to find VCs who would be interested in the non-tech companies, her sector being food processing, which is one of the highly potential sectors.
So, Neha, it's a very unfortunate to learn about your experience. In one of my previous slide, I did highlight that you need to identify right investor for you. I would take a liberty to say that probably you may not have approached a right investor. However, would be happy to help you if you can write to me, or you can even share your plan or contact coordinates with NEN, who can in turn share with me, and I would be happy to help you to connect right guys. So it's very important to identify right investor who would be more than happy to look at your business plan. If you have been shortlisted as one of the upcoming and most promising startup, then you would find a good investor. So happy to help you. Please take my coordinates from organizers, and I would be more than happy to help you.
Right. Thank you, Anil. Our next question is from Ashish. He asks, what is your advice for people looking forward to raise capital for manufacturing ventures?
So manufacturing ventures, I presume, would involve two components. One would be capital expense, that could be long-term funding, and short-term funding is to have working capital need. So I would suggest for blend of both equity and debt, maybe around 20 to 25% or 30% of equity and balance through debt, which most nationalized bank or private bank would be happy to do it. Depending upon project, you can approach investors as well as banks for debt funding.
Our next question is from Kunal. He says, a VC who has funded your competitor, should you approach them for funding? What are the risks?
So normally VCs don't invest in competing businesses. However, VCs would be happy to fund complementary businesses in same space. So whenever you approach a VC, one of slide I said, do your homework to see what kind of investments they have made, and if there is any conflict and they have still shown an interest, so you can in very first meeting talk about your concern, ask for, whether they would be comfortable doing non-disclosure, and if not, then would they be comfortable, looking at your business which is competing with their existing investment. If they feel there is a conflict, then they would be upfront and may not, discuss your business plan. But if they say that they don't see any conflict and would be happy to look at you, then I don't think there is, any harm in sharing basic information with them, because in 1 or 2 meetings you will make out, whether they are genuinely interested or not. And if not, then you can disengage and look for some other investor. But normally, even like in our case, we do a lot of investments. When we identify there could be some conflict, we ourselves, highlight that to potential investee and ask them whether they are comfortable sharing. If they are not comfortable, then we don't, waste their time. But if they are comfortable, then with all due respect, we do hear them out. And in case we don't see any conflict, then we do explore funding options with them. Next.
Next question is from Mridul. He says, from your angel versus VC, angels expect returns, but you mentioned at the start Mumbai Angels is not for profit. Can you elaborate more on how does Mumbai Angel work?
So Mumbai Angel is a no-profit organization which enables investor and investee to explore investment options. So as an organization, we don't invest money in companies. Money is invested by members who are member of Mumbai Angels. So we basically help members to identify right kind of opportunity to invest. So investors do expect return, but as an organization, we don't. We have formed an organization which is basically with an objective to promote entrepreneurship and provide early stage capital. So world over, most of angel groups are non-profit as far as operations are concerned, but as far as investors, they do expect return on their investment. I hope it helps.
Is from Saurabh.
Next.
Yeah, our next question is from Saurabh. He says, would I have to approach investors keeping in mind the type of business they invest in? Because he run a theatre production startup. Which kind of investor would be interested?
Can you repeat your question?
Yeah, he says that would I have to approach investors keeping in mind the type of business that they invest in? He runs a theatre production startup and wishes to know which kind of investor would be interested.
So my suggestion is that you should certainly look out for investors who would be happy to invest in your kind of space. As I said earlier, there is no point looking for some guys who are in clean tech and you are in IT. For example, you are in creative field. Probably you need to look at an VC, either who's sector agnostic or who have, inclination to invest in your kind of sector. So you should certainly do your homework, identify which VC would be, happy to look at your sector.
Okay, our next question is from Anubhav. He says, what is the right time to pursue fundraising? Should we initially focus on tightening operation or divert attention to fundraising?
So the fact of life is that, business cannot run, without right kind of resources. So initially, you may be able to bootstrap. However, for growth, you would need, money to raise. So as an entrepreneur, you are expected to, spend time on fundraising. The typical cycle for fundraising is anywhere from 3 to 9 months. In some cases, it is even 12 months. So based upon how much you are able to run without any external fund, you can delay. But if you are left with, let's say, 6 months or 9 months of resources, then I would strongly suggest look for funding options, start approaching investors, because fundraising do take time, typically for due diligence, negotiations, making people aware about your plan, venture, get them excited. So one should raise fund when they are left with working capital of around 6 months or so.
Our next question is from Shakti. It says, what's your insight on education industry, and also wanted to know if there is a chance to get funded in India when he has his LLC set up in Texas, USA.
So this is one of the hot sector. We ourselves have couple of investment in education sector. In fact, there was a very big one-page article yesterday in Economic Times which talks about $80 billion opportunity. So I think it's a upcoming space, lot to do. As far as investing outside India is concerned, I think that's not a limitation. We have investment outside India, and likewise other investors also have investment outside India. About LLC, I think once investors like any opportunity, any deal, I think you can always structure, company, whether LLC or LLP or proper format of company, because I presume you are based out of US. It depends whether you are C Corp, S Corp. So normally people prefer investing in S Corp, which has better governance and compliances. So to address, yes, it's interesting space to invest in. Investors are open to explore investments outside India as well.
Next question is from Ashwini.
Next.
Yeah, our next question is from Ashwini. He asks, can an angel or a VC invest on unique idea or concept? He has created world's first video interactive news network, and he's asking how can he get an investor for the same?
Yes, you can. As I said, you can identify who could be a potential investor in your company or in your idea. Write an email to them or see if somebody can make an introduction to your potential investors. If you wish, you can share your business plan with us in case we can explore. Would be happy to do that, or we'll make introduction to right kind of investors.
Next question is from Arun Kumar. Our next question is from Arun Kumar. He asks, when going for funding, if they ask why your angel investors or previous VCs are not ready to invest more, what kind of reply we should give to them?
So, see, it's a very tricky situation. Normally, angel investors do first round or maybe a very small bridge round, but post that angel investor doesn't keep on doing, because at the end of the day they are angel investment and they have basic appetite. As far as VCs are concerned, I presume all VCs are happy to invest to their pro rata right, but if you need to establish enterprise value, you need to bring in outside investor, and that's the reason existing VC will never do full round unless until you happen to be sure shot winner for them. And also it's advisable for you, because if you take full round from your existing VC, how would you establish the valuation? That's the reason you bring external VCs to establish value, and existing new investor and existing investors would be more than happy to prorate. That's what I have seen in India happening. So I hope it helps you addressing your question.
Our next question is from Shiv. He says he is going to start an e-commerce company, but whenever he approaches an investor, they say that there are already many companies, you can't beat them. So how can he raise money?
So it's true, e-commerce space actually has become crowded, and even the leaders in this space are not making money. Having said that, in case you have very unique idea and you know that you can beat the competition and can be a winner, then go for it. I think once you have proven the concept, once you have shown good tractions, investors will look at it. But at concept stage, it becomes very difficult for investors to visualize, because as a space, e-commerce is not doing too well today. So you need to work, you need to prove, and then probably you may be able to excite investors. Otherwise, as of now, the space is slightly crowded, and the industry is making losses as of now. So that could be the reason for investors not being too excited at concept stage. So I would suggest work in a smaller way, make some investments, prove that you have a winning idea, and if you are showing good tractions, investors will definitely look at you.
So the last two questions for the day. First is by Ranjot. He says, how do you value a startup after 6 months into operations?
So it's a topic in itself. It's very difficult for me to do justice to your question. But I can give you some snapshot. Startups, basically, there's no science, neither it's an art. Basically, it's between art and science. As a thumb rule, startups are normally get valued in range of 1 million in India, and in US it's the typical valuation for a startup is in range of $2.5 million. And the factor which basically govern the valuation at initial stage, even if 6 months or 12 months, is how strong is team, what kind of relevant experience they have, can they deliver and crack the market, do you have any IP, do you have any entry barrier, how big is the market, can you be a global company. If you have all this initial factor, and can you actually offer an exit as well. So if you have this 4-5 ingredients in place, you can expect your company to be valued in range of 1 to 2 million. And if it is really very disruptive and very scalable, addressing big market, you can even expect higher valuation. So it all depends: team, IPR, market, entry barriers, and potential exit. That would define the valuation of a startup. In India, it's in range of 1-2 million, and outside India is slightly higher.
Last question.
Next.
Yeah, our last question for the day is by Anubhav. He says, let's say if the overall project cost for 4 years is 200 crore, and for the first year you need only 10 lakhs, how much should we ask for?
Can you repeat your question?
Yeah, he says, let's say if the overall project cost for 4 years is 200 crore, and for the first year you need only 10 lakhs, how much should we ask for?
So during fundraising, I strongly recommend all potential investors to look for how much money you need for 18 to 24 months, and based upon that you should raise it, whether it is few lakhs or few crore, because it takes time to deliver. By the time money comes in your bank, situation has changed, parameters have changed, your assumptions will change, so your project will get delayed, your deliverables will get impacted. So if you just raise it for 10-12 months, you will be not in position to show good traction for next fundraising cycle. So I strongly recommend everyone to look for raising at least for 18 to 24 months. Addressing specific question, if the overall project cost is 200 crore and initially is just 10 lakhs, to me it looks like it's just for proof of concept, then probably you should look for individual investors who would be willing to risk that that kind of money for proof of concept, or you should look at for incubator who would be happy to provide you, that kind of support initially for 8 to 10 months apart from money. I hope that that helps addressing the question.
Right. Thank you so much, Anil, for that interesting session and the Q&A. A lot of people have asked for your email ID. So,
you can share it. It's anil@mumbaiangels.com. Maybe you can type, and you have my email ID, so you can share with them, no problem.
All right. Okay. Thank you.
Yeah.
And
thanks for having me here, and also thank all participants, spending 1 hour listening me. I hope it was useful. In case you have any further queries, you can email it to organizers, and maybe I can take it up offline to emails.
All right.
Thank you very much.
Thank you so much, Anil. Thank you to all our attendees for participating in the webinar. Please do send in your feedbacks and suggestions to eclub@nenglobal.org, and also if you found the session interesting, feel free to blog or post about it. The recorded version will be available soon. NEN Entrepreneurs Support Program is conducting a one-day workshop for entrepreneurs on raising fund in Pune, Chennai and Delhi on June 29th. The registrations will open soon. You can find the details on nenonline.tv. Also join us for our next webinar on how to pitch to a VC, Insider's Guide on Raising Money by Shailesh Vikram Singh of Seed Fund on June 12th at 3 p.m. Thank you once again and have a nice evening. Thank you.
Bye.